Hey everyone, welcome to today's video. Before moving on to the main video for today, I thought that I will shoot a very important segment about today's stock market fall. I'll speak in basic bullet points so that we retain majority of the information. So point number one is that as I'm shooting this video during the market hours, the market has fallen by roughly 2.5%. This has led to a lot of panic. Media channels said, what, wealth has been destroyed, NSE, BSE has gone crazy, bonkers, and everyone is losing their wealth, and this is like end of everything. No, so please do not panic. These type of corrections will keep on happening. As we discussed through my previous videos earlier, that the markets are moving sideways. They will continue, or they are continuing to move in a range of 16,000 Nifty to 18,200 Nifty. That is the range. So at any time, 5% uprun can also happen, 5% downfall can also happen. So please do not panic. That's part A. Part B, inflation is very high. What are you going to do with the money that you are keeping? So you have to invest on every fall. Which brings us to point number 3, that hey, where should I be investing? So today, if you analyze the reason for the market fall, the reason is that hey, IT stocks have not given a run up. Poor performance, poor quarterly results. So therefore, something like Infosys has fallen by 7%. TCS has also fallen. Am I an investor in these companies? No. I have explained why in some of my earlier videos. But if you check FMCG, which was lagging for a little while, it has given an uprun. You should not panic in such situations. This in simple terms is called a sector rotation and it will keep on happening. Important point is that whenever you find quality stocks under such correction, please aggregate it. For example, today, HDFC Bank fell by 4.5%. Go a week back, right? Everyone, every media outlet, every commentator was saying that, we are buying like more of HDFC Bank. Just Google it and see, right? A lot of people were buying HDFC Bank when HDFC Bank gave like a 20-25% run up. Then it has corrected after that. Now is the time to buy. And this is not a buying or selling recommendation. I'm just saying that, correction has happened on a major stock. So I decided to buy more of HDFC Bank today. I was already an investor. So please keep these basic points in mind. People will always try to sell you news. People will always try to make you panic on things where you should not be panicking. Please do not worry about all these things, especially if you are a beginner. Now moving on to the main video for today, which is about mutual funds. It's an important video, especially if you're a beginner. Please watch it. If you do SIPs and mutual funds, again, please watch it. This video can help you save a lot of commissions. So over to this video. So you should remember the following key points. Number 1 are the commissions. That whenever you are trying to invest in a mutual fund, please try to pick a mutual fund that has the lowest commissions possible. Traditionally speaking, hybrid mutual funds have very high commissions. Small cap and mid cap mutual funds also have very high commissions. Hi everyone, welcome to today's video. So on today's video, I am going to speak about how you can create a mutual fund portfolio of 1 lakh rupee very sensibly. Why is this video important? 2 very quick reasons. One is that many of you might be starting your investing journey and mutual fund investing becomes a go-to option. But many of you end up making a lot of mistakes. So hopefully through this short video, you will be able to avoid these mistakes and save a lot of money. Second key reason is that inflation in the economy is going haywire. So the word of the day today is haywire. So let me know what does that mean. So the inflation in the economy is going haywire. And if you just sit on cash and if you don't invest, or if you just simply wait for the market to correct and then only I will invest, you will end up making a lot of losses. I can guarantee that to you. So from that viewpoint, it becomes very important for us to understand the mutual fund industry and start taking some positions accordingly. Along the way, I will share my biggest holding in one of the mutual fund. Why have I done that? I will also explain you the rationale. So let us get the video started and I will speak in 4 simple points. So point number 1 is that you must understand the basics of mutual funds. I have made a complete video here, but I will give you a very quick synopsis by encapsulating some of the key points. So you need to understand 3 very quick points. One is that when you are picking stocks directly, that is when you will make a lot of money, because direct stock picking involves the least amount of commissions possible and the opportunity for growth is massive. So depending on your skill set, you can make even 30% CAGR on annual basis by direct stock picking, and it is the most profitable way to benefit from the stock market. No doubt about that. So this brings us to a legitimate question that, okay, then why are you talking about mutual fund? Should I not be learning about stock picking? Yes, you should be learning about stock picking, but a few things might play out. One, that you might be a novice in stock market investing. So you might not be able to take positions immediately and you will keep on waiting thinking that, okay, once I read like 500 books on stock market, only then I will invest directly in stocks only. Till then I will not take any positions. So through that thought process, you will end up missing a series of opportunities. So please don't do that. Additionally, there might be circumstances that you're too busy with work. You just don't have time to watch, follow news, take positions, do analysis, all that stuff. So again, direct stock picking becomes very challenging for you. Third and finally, if you're just looking to build a system of investment, then mutual fund investing is very simple. That okay, my salary comes and I send 30% of my salary in an SIP in a mutual fund. So depending on your skill set, life circumstances, professional circumstances, it might be sensible for you to at least start your journey with mutual funds and then graduate to making investments directly in stocks. But when you start your investment journey in the mutual fund market, please remember these two keywords. One is called as direct plans and one is called as regular plans. Whenever you try to find good mutual funds to invest in, you might be shown both these options. Now the difference is that if you go via the regular route, there are more commissions involved. Why is that? Because there is a mutual fund agent who is likely to advise you what to invest in versus not invest in, and because there is additional person at play, so your commissions go up. So please don't opt for regular plans, opt for direct plans. Your commissions are going to be lower. Here is an entire chart that shows the difference between direct and regular. But to cut the entire story short, please just directly go and pick direct mutual funds. That is an easiest way to invest also and the least commission oriented way. So now comes the natural question that okay, then what are my options in terms of mutual fund investing? Now there are 1,000 categorizations of mutual funds. I'll give you a very quick synopsis here. So broadly speaking, there are 4 types. For example, an equity based mutual fund simply means that a briefcase is created and it might be called SBI Top 50 Mutual Fund, something like this. So this is created. And here the underlying asset is equities. So these would be company stocks like ITC, Nestle, Marico, etc., right? So these are called as equity based. Then comes debt mutual funds. So debt mutual fund simply means that instead of equity in your briefcase, you are holding debt. Debt simply means bond. Bonds are slightly safer. So usually you would have seen that debt mutual funds are safer, but they give lower returns compared to equity mutual funds. Then comes the third category. This is called as hybrid mutual funds. And this is a collection of both debt and equity. So there will be maybe 50% debt, 50% equity, or 70% debt, 30% equity. So all this mixing and matching happens in hybrid mutual funds. Fourth and finally comes the index mutual fund. For example, in India, you have 2 broad indices. One is called as Nifty 50, which is the collection of top 50 stocks in India, and Sensex. These are the 2 market indices, and you can go and buy either Nifty 50 based mutual funds or Sensex based mutual fund. Now these ones are called as actively managed mutual funds, and these type of funds are called as passively managed mutual funds. So these are the broad categorization. Other layer of categorizations can be introduced on mutual funds. For example, large cap, mid cap, small cap. That depicts the size of the company that you are investing in. So to cut the long story short, the mutual fund categorizations are limitless. A lot of ways mutual funds can be sliced and diced and new categories can be created. But broadly, if you remember these 4 categories, majority of the classification is done. Now comes the third important point that okay, I'm looking to take some positions in the mutual fund. What is it that I should keep in mind? So you should remember the following key points. Number 1 are the commissions. That whenever you are trying to invest in a mutual fund, please try to pick a mutual fund that has the lowest commissions possible. Traditionally speaking, hybrid mutual funds have very high commissions. Small cap and mid cap mutual funds also have very high commissions. When it comes to index mutual funds, because these are passively managed means that they are just simply mirroring the index. The mutual fund manager who is looking at the design of this briefcase, he is not trying to pick the underlying assets like equities and debts by using his brain. What he or she is simply doing is that he is looking at that, okay, Nifty 50, these 50 stocks, I am going to buy it in the exact same proportion of Nifty 50. So he or she is simply trying to mirror the index. So as a result, the commissions on index funds are low. So take a look at this particular mutual fund. What you will see is that commissions are also charged in terms of the exit load or expense ratio. So please be cognizant about this. In some of the hybrid mutual funds, for example, the expense ratio can go up to roughly 1.5-2% also, which is very, very high fees and commissions. Now comes the second point, that if I'm investing in different types of mutual funds, what is the expected return I can make? Okay, so let us have a very brief conversation about that. Here is a very important chart that will help you understand the return difference of actively managed mutual funds vis-a-vis ETF/index funds. So this is 2018 data, but the principle remains exactly the same, that the top actively managed mutual fund means that the mutual fund manager is sitting and actively trading security using a lot of their own brain. So even if we pick top actively managed mutual funds, these are the best ones. So they have given like 15%, 13, 12, 11.5%. Compare this with ETFs or exchange traded funds. These are passive. Here the mutual fund manager is not sitting and using their brain. They are just simply mirroring the index. So these passively managed mutual funds beat majority of the large cap equity based mutual funds, as can be seen from this chart. So now comes the natural question that, okay, in that scenario, should I only just go and invest in index funds? The answer is that it depends. It depends on a lot of things, and the most important thing that this answer depends on is that you must be able to assess risk adjusted returns. Now, what is meant by risk adjusted returns? Let me give you a very quick synopsis. So what are risk adjusted returns? Let me just run you through an example that will clarify this point. So for example, let's say that you buy a small cap mutual fund and it ends up giving you 12%. You will feel very happy that, hey, you know what, I'm making like 12% return. But let's say that even the index mutual fund ends up giving you roughly 12% return. Then in such a scenario, buying this small cap fund, was it a sensible decision? The answer was no. Why? Because small cap have much higher risk compared to index funds. So by taking higher risk, you have made exactly the same amount of return that you would have made by investing directly in index mutual funds. So if you see in your portfolio that some of your mutual funds, which are small cap, are not giving you market adjusted returns also, it might probably be the time to sell it. Same applies to large cap equity based mutual funds, that let's say that they also give you 12% return. So in this scenario, was it a good decision to buy this large cap equity based mutual fund? Again, the answer is no. Why? Because A, this is likely to be an actively managed mutual fund, so your commissions are going to be higher. And B, your mutual fund manager would have picked a subset of this index fund, and despite that, he or she was able to generate, again, the market returns only. So there was no point in buying these mutual funds. So I hope this clarifies the point that what are risk adjusted returns. If you are going with small cap mutual funds or mid cap mutual funds or even large cap mutual funds, they should ideally be beating the market or the index funds. If that is not happening, then you are taking much higher unit of risk and probably paying much higher commissions to make exactly the same returns that you would have made from your passive funds. So with this discussion out of the way, let us quickly discuss how we can build a portfolio with 1 lakh rupees into mutual funds. So this is what my biggest holding in mutual fund looks like, that I have invested a large chunk of my own money in a passive mutual fund. I had made a video a few days back explaining the rationale, but a very quick point around that would be that I had purchased this passive mutual fund. Why? Because it allows me to swing trade it. So I'm swing trading the Nifty. So that was the first point. Second reason why I picked was that this is a passive mutual fund. So it allows me to lower my commissions. And Navi by default was coming out to be the best in terms of expense ratio and any exit load that they would charge. So from that perspective, I invested my money. In case you can find a better mutual fund where the expense ratio is low or the exit load is lower, let me know. I'll be very happy to shift my position. Okay, so coming to the 1 lakh rupee investment. So if you are an average investor and you don't need any jig, please invest 100% of your portfolio in passive mutual funds. Why? Because the commissions are low. It is very easy to do your SIP in a passive mutual fund also. You don't need to get scared if the markets are going down. You don't need to track individual sectors. All that stuff need not be taken care of. So for an average investor, keeping 100% of your mutual fund money in passive mutual fund is completely okay. Now comes the story of a slightly more aggressive investor. Now, if you're an aggressive investor, you need to take at least 50% of your position in small cap and mid cap based mutual funds, right? So 50% of your money goes to small cap and mid cap, and rest 50% could either go to index funds or 50% can go to large cap equity based mutual funds. Generally, I will recommend avoiding hybrid mutual funds because the commissions are the highest. Now, what about super aggressive investors? Now, in that scenario, you should learn about direct stock picking and take some positions in direct stocks. Please don't go via mutual fund route. So parting thoughts and the summary of the video is that passive mutual funds are really good. There is no problem there. Depending on your risk appetite, you can design your portfolio and play around with it. You should try to avoid commissions on mutual funds as much as possible. And finally, if you're a super aggressive investor, mutual fund can be a great starting point, but definitely do graduate to investing in stocks directly. I hope you enjoyed the video. Please press the like button and I will see you tomorrow.